Back. I hope you all are doing very well. So today let's talk about YTM, right? So today we are decoding a yield to maturity. Well, a fancy word for telling someone what a return on a bond is, right? So let's break it down in a very simple manner. Yeah, right. So I'll give you an example through which we'll understand this YTM. What is there? So let's say I am buying a used car, correct? So let's say I'm buying a used Honda City. Let's say the new price is 11 lakhs and I have got a good deal at 4 lakhs. It is just 30,000 kilometers driven, and I've got a good deal at 4 lakhs. So I bought the Honda City at 4 lakhs. Now I'm using it for some time and driving it for 30,000 more kilometers, and let's say I'm later reselling it after 5 years, and now let's say my sales pitch is good, and I'm selling that car for, let's say, 6 lakhs, right? So now in this deal, what has happened? I've got a value which was underpriced, right? I took the benefits in the 5 years, 5 year period, and then I sold it at a higher price, right? So this total return which I have got of this deal, that is my YTM. So if you compare, if I have bought the Honda City at 4 lakhs and if I'm using it for 5 years, the ideal value is lesser than 4 lakhs according to me, right? Let's say it is 2 lakhs, but I've sold it for 6 lakhs. This 4 lakhs which I have got, this total return of 4 lakhs in a percentage terms, that is called YTM. Now let's try to understand this in terms of the corporate finance, right? So let's say a bond is there and it is trading at a discount, right? So let's say a bond has a face value of 1,000, as we have discussed in the previous video, and it is trading at 900 rupees, which means that it is trading at 100 rupees discount. Now I buy that bond, and let's say the coupon rate is 5%. So always remember that coupon rate is only face value. So coupon rate is 5%, which means that it is 5% of the 1,000 rupees, which means that I'm getting 50 rupees annually, right? Perfect. Now I'm getting 50 rupees annually, and let's say after 5 years, I return that bond to the company, right? And let's say the maturity was 5 years. So what happens in this case? For 5 years, I am earning 50, 50, 50, 50 rupees. But at the end, when the company pays me back, they are paying me 1,000 rupees. But I bought that bond for 900 rupees, which means that I'm adding this 100 extra, right? So now this extra 100 plus all those 50 interest payments, including everything, what my total return is, what the YTM tells you, right? So again, there are formulas and you don't have to do the math because Excel can do it for you. If you have the present value, if you have the future value, if you have the coupon rate, and if you have the period, if you have the coupon rate, you can calculate the periodic payment. You have the maturity here, you can easily put it in Excel, and Excel will give you the YTM, right? So higher the YTM, more return on the bond is, but be aware that if YTM is higher, then the risk on the bond is also higher, right? So this is all about YTM. If you got any questions, please drop in the comments, and please drop whatever you want in the next video. Thank you so much. Bye bye, and take care. Please subscribe.